Oh boy, just when you thought things couldn't get any worse and we weren't going to see any more craziness out of the market in the short term. I mean, we have been seeing a lot of volatility, but essentially the Fed's favorite yield curve indicator has just flipped, signaling a recession. So it's going to be interesting to see exactly how they're going to spin it this time ahead of the Fed meeting next week. We have to talk about that. We're going to be talking about the charts here too. Some very interesting buying behavior and actually overall trading behavior happening in the market now. But again, guys, this is incredibly important info. You guys need to know this if you are trading in this market or have any money in this market right now. So again, before we get into all of that information, if you wouldn't mind hitting that like button down below, really helps get this information out to more people over here, helps out with the YouTube algorithms. And if you do want to see more videos like this, make sure you hit that subscribe button down below and leave a comment as well. So let's get right into the charts here before we actually break down some of this information. So on the 4-hour time frame for SPY right here, we did end up seeing it breach this 200 EMA. Now, we ended up seeing it run up to about 387.50. Now, what we were saying on all the streams today is, well, why did it reject so hard? Now, what you have to look at is we've seen this rally all the way from these lows to about 348 here, all the way to these highs of about 387.50, almost 388 there. So that's an almost 40-point move in the SPY. If you were short down here and were getting out of your positions as we were moving back up, well, 387.50 is a logical point to come back in short in the overall market here. Now, some of the other things that we need to look at here, the MACD is losing momentum. We're seeing the RSI crossing below its moving average here. And if you look at this on the 5-minute time frame, these were some aggressive moves to the downside off of these highs. And something that was pointed out today is that from this run, since about 365 over here, we have not seen SPY come down below the 5-minute 200 exponential moving average, but we just saw it happen today. Now, Facebook has missed earnings, so they are selling off. That could have an effect on the overall market going into tomorrow. We have a big earnings slate tomorrow morning. We have GDP data also coming out tomorrow. And then we're also going to be getting Intel, Amazon, and Apple's earnings after close. So tomorrow is really, really crazy. Now, again, if you're looking at the dollar over here, nothing too crazy was happening with it today. Again, it was down about 1%, which is notable. But it wasn't really something that we were staring at all day long to give us an indication of a lot of these moves. We caught that move to the upside. The dollar was selling off with it, but there is something very interesting happening with bonds that we are going to be talking about in a little bit. But again, guys, if you are trading in these markets right now, it really will benefit you to have a group of people that are going to be able to help you along the way. And again, I can show you guys gains after gains after gains in our premium Discord right now. But at the same time, 80% of trading is going to be mindset and money management. I talk about those 3 M's a lot, and I like to really give you guys a lot of those lessons every single day. Yes, we have those proprietary algorithms that are killing it. Yes, we're always live. We have those curriculum videos. We have the fastest alerts. But again, the things that we're going to be able to provide you in terms of overall money management skills are going to put you guys into that next level. So if you guys are interested, make sure you check out that link down below. If not, completely fine. Let's get on with the video over here. So this is the buying behavior that I find very interesting and honestly should be a little bit shocking and worrisome for market moves going into the next couple of weeks here. Now, this article, let's just get right into it. So maybe they got tired with sitting on their hands in the proverbial sidelines or have run out of stocks to sell or short. But for whatever reason, last week when the SP 500 soared 4.7%, its best week since June, both institutional and retail investors flooded back into the market at near record amounts. See more details. Over the last 3 weeks, inflows into single stocks as a percentage of S&P 500 market cap were in the 99th percentile, meaning that the buying amount was greater than 99% of other periods that was being looked at in this data here. And that's pretty significant. Now, the reason why we're talking about this here is, remember, when we were at those market lows, we were seeing an aggressive amount of put contracts coming in. We were seeing aggressive amounts of selling. And then what happened? Everything got bought right back up and we started to rally up off of those lows. So what would happen on the flip side if everybody is flipping to long? Well, the logical move would be that they start to push things down. Now, it's going to depend on what happens with earnings and everything like that, and all the data that's going to come out. But again, I would be worrisome for some more downside. I've said this a lot. I don't think the market has bottomed yet. We have too many negative catalysts out there that need to get resolved in order for us to get back to some form of normalcy. Now, let's get into this situation with bonds because this is incredibly important. And you have to understand why we're looking at these two yields and these two bonds versus other yields. So going over to this arc or this chart right here, we can see, and we're going to go through why this is important. We're looking at the US 10-year Treasury yield on a 30-minute time frame right here. Now, when we look at what was happening since last Monday, you can see that the yields are coming down. Now, what that essentially means is that people are buying up bonds when yields are coming down, bonds are increasing. Now, that does show a little bit more demand for the 10-year Treasury. Now, if we look at the 3-month yields and we go back to last Monday over here, well, you can see that last Monday was right around here, and we see that these yields are starting to head up or even maintain a little bit of flatness. So you're seeing basically equal demand or selling pressure on these 3-month Treasury yields. Now, what does this mean? Well, the Fed's favorite yield curve indicator finally reversed recession imminent. The last 4 days have seen the 10-year yields plunged almost 35 basis points from their highs, while the 3-month bill has crept higher by around 12 basis points, which has left the much-watched and Fed-blessed indicator of recessions, the 3-month 10-year Treasury yield spread, has finally gone negative after watching every other segment of the curve invert. Now, why is this yield curve indicator so important? Simple. While the 2s and 10s and so on are so much discussed, they are quickly shrugged off by the permabull crowd as being overly sensitive. Again, because as you can see here, they're predicting 10 of the last 5 recessions. For example, in the case of the 3-month 10-year spread, no lesser vulnerable institute than the Federal Reserve, our preferred combination of Treasury rates proves very successful in predicting the recessions of recent decades. The monthly average spread between the 10-year constant maturity rate and the 3-month secondary market rate on a bond equivalent basis has turned negative before each recession in the period from January 1968 to July 2006. So it's predicted every single recession. That is not necessarily the best sign as we are going into midterms, the end of the year earnings season, rate hikes, the conflict between Russia and Ukraine, the potential conflict between China and Taiwan. We have OPEC, oil problems, the energy crisis, the UK starting to sell their treasury or their gilts. This is not a good situation to be in. So going into the next couple of trading days and weeks, we have to watch as this spread potentially gets even more negative. If it does, that's going to be an even bigger flashing sign of a recession. Now, the other thing to look at here is if they then try and change this definition, because this is the Fed's preferred metric of really giving an indication that there is going to be a recession. Are they going to declare it, or are they going to just continue to kick the can down the road? Now, again, tomorrow, before open here, we are going to have Shopify earnings, McDonald's, Caterpillar, Southwest, and MasterCard. Shopify will be interesting. MasterCard can give us a little bit of an indication of consumer sentiment. And what it's really going to give us an idea of is if inflation expectations are actually becoming entrenched, like Powell was talking about back at his Jackson Hole symposium. The reason for this is that if people are deciding to buy goods right now, that tells us a lot about what they think about prices. If they think that prices are going to go down in the future, they'll forego buying a lot of these discretionary goods now and wait for them to come down in price. But if they don't and they start buying these goods now, well, it tells us that they think that inflationary pressures are going to persist and those prices of those goods are not actually going to come down over the next, let's say, 6, 8, 12 months. Then we have Apple after close, big S&P component there, Amazon, Intel, and Pinterest. So there's a lot of crazy things happening here, And I want you guys to make sure that you're able to protect yourselves in the best way that you can. Again, if you're going to be swing trading, make sure that you're getting enough time on these contracts here, everybody. You do not want to get caught in an overnight gap up or gap down against your position. Those intraday trades are what I'm going to be sticking with, and I'm going to be walking you guys through all of those on every live stream that we're doing every single morning. So again, guys, that is going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening. I'll see you in the next one. Peace.